Today's topic is buy and hold forever, 9 dividend stocks. So this article I bring from fidelity.com. So 9 dividend stocks, buy and hold forever. So in this time, looks beyond the short-term trend to invest in long-term income. And this time is the stock market is very volatile, so we are looking for some stocks more stable. So these stocks are the good example for uh, the stable and then pay dividends and then holding for a long time. So these are the names and tickers. So we're gonna see one by one. First one is the NVS. So the Novartis is the global pharmaceutical company located in Swiss. So it pays dividends once a year, like usual companies in Europe or Asia. So the dividend is 3.73%, and payout ratio is at 89.5%. When you see the chart, the actual chart come from the finviz.com, and the recently, in the March, so it way down and then recurved and it go to the on the side and recently going down. So I think in it, though if you want to buy this, just adding on your watch list, and then when it going down and then it going up trend, then at that time I think you can think about the buying time. And pharmaceutical companies, um, in my case, I have a Merck, but when you have a Johnson& Johnson or Pfizer, whatever you have, I think one of them, in the good folder, you can holding as a dividend stocks, and the other one is if you're looking for some like growth way of the pharmaceutical company, then my suggestion for you is the not the individual stocks. I want to have IBB, so it's the ETF for the group of pharmaceutical companies, because like 10 years ago, 20 years ago, it's easy to, not easy, but anyway, compared to this time, it's easier to develop new medicine. But recently, it's very hard, even though we're using the AI. So it's when you have a group of companies, one of them they developed a new medicine. So the IBB is more better, and the other one is the more innovative companies. Then, as you know, the ARK investor groups, one of the yeah, this part, biological or biotech companies, that's the ARKG. So recently that the ARKG is too much, the price go up, so it's overvalued. So now it's recently corrected. So after that day, this time, so I think it's going up to the next year, um, the Q2 times. Okay. This is a NHI, so it's a National Health Investor, which means it's rich. So they rich company, this is the um, company they investing in the real estate, and then they more focus on the pay dividend. So that's why the payout ratio is 99.3%, and dividend is 6.72%. So NHI, mostly they focus on the senior housing facilities and retirement communities. So that includes the hospital and medical office building. So the baby boomers retire more, which means the more seniors. So in the future, I think NHI is more growing. So as you see in the chart, it showing the uptrend. So it was compared to the growth stocks, but it going up slowly, but it keep going up with the good dividends. That's the attractive point of this stock. So next is the pet medicine. The ticker is PETS. So dividend is 3.51%, payout is 85.5%. So in the chart, if it was the actually uh, benefited by pandemic situation, because like other online shoppings or stay-at-home stocks, so it was going up because the more people stay with their pet. So it has the go up with the the um, hope, but actually the it didn't go much further up because their earning report is not so great. So they go to the side, and then in the July their earning report was disappointed. That's why it plunged down. So and then now making the bottom again. So when you see they grow slowly up, but we're not sure that they can making more earnings or not. So this one you need to carefully watching, and then see here is the 200 average curve. When this curve meet like the close with the price, at that time I think it have a up trend momentum. So this one is the Amcor. Amcor is the well, it's growing with the online retail shops. Well, online retail shops growing, then they, which means the people order through the online retail, and when they got the packaging, so this company making packaging, the paper box things. So this company also is the the after pandemic, it grows very faster. But as you see it didn't go up to the last high point, and then stay and then go to side because um, in US the unemployment rate is not too much different, and then the or maybe second wave of pandemic, or still the lot of people unemployed, which means people cannot make money. So even though they stay home, they cannot shopping online anymore. Maybe all same level. That's why we expecting their earning level is not so greatly go up on if the pandemic is not over. That's why the stock price going side. And so dividend is 4.26%, payout is 140.9%. So which means that they pay out more dividends than their earnings. So that's why I explained, we thinking that their earnings not growing suddenly go up, so going side. So I want to hold it. I mean, just to put it in your watch list, but I don't recommend buying now. This is the Verizon. So Verizon is kind of safe and then the long-term invest. But you always when you're talking about the Verizon, you need to think about the T-Mobile. Not, I'm sorry, AT&T. So AT&T is the dividends is about 6%, a little bit higher, and then the payout ratio is I think a little bit more than the 52%, so it's a little bit higher than the Verizon. But Verizon is more focused on the communication business, the wireless or internet provider business. But AT&T now communication business, and together with like a Netflix. So we are a little bit the have a question about the AT&T value. So AT&T stock, the company, in case regarded as like a Netflix, then maybe the price go up more higher. But otherwise, the AT&T stock price going on the side, because they spend a lot of money, which means they have a lot of bond debts to buy to uh, to buy, was it to bought, I mean, what to say, the acquisition of Dish and Time Warner. For that, they spend too much money, so that's why they have a high debt. So AT&T take a time, going back, I mean, going up trend. And but Verizon, compared to the AT&T, we expecting the it tried the resistance here. So it's this time it looks like it going uptrend possible. So it's um, maybe this time it's and then the 20 days average, and then 50 days making making the golden cross. So it's, I think when you buy this time, we maybe have uh, the some higher return we can expect. So this one is the TD. So this one is the bank, is the bank located, the headquarters located in Toronto. So it's the Canadian bank. And then this one always the talked when we have a kind of the crisis. So this one is a very good stocks, one of the very best stocks when in this kind of crisis. So it's the I want to make a note on below this stocks. So when you have the any case like the stock price plunging, so market plunging, that time we should buy this stock first. So it's because they pay a sweet dividend, and then and very safe and stable compared to the American bank, because and actually this bank is the bigger than Goldman Sachs, and then there are more businesses not risky like Goldman Sachs or Bank of America or Citibank. They more focus on the retail banking only. I mean mostly. So um, the so dividends is kind of guaranteed, and then it go up more than inflation rate. So the buy and holding forever, I think that's the one of the best example. So the now price is $45 around, and then the before the pandemic, the price is um, over 55. So I'm sure the price and the stock price go catch up to that level, okay? But we're not sure that after that maybe it go to the side. So if you buy this time, maybe that's the good time to buy. This is a Duke Energy, so they have uh, over 8, or not over, nearly 8 million electric consumers across the 6 different states, and natural gas distribution network, and serving close to 2 million customers. So this one is the utility stock is very safe, but we picked the article picked the Duke Energy because uh, they consistently pay dividends, and then they increase dividends every year. And then as you see in the chart, they showing the uptrend. So it's uh, it probably go to at least go to the $90 level in the short term, and later on it go up to the $100 level, maybe probably the next year this time. This one is the one OK stock. So this one is also related to the energy part, but this one is more oil and gas, and this part is this company more do the piping service and tank service. So even though the oil price is going down, but they need using the facilities like pipe and tank and processing facilities. So this company has anyway the beneficial from the the oil consuming or producing. So not so the attractive stock, but when you think about their dividends, it's not bad, I mean very good, and then the stock price is the going up slower, so it's the probably the the increase more than inflation rate, so it's the good stock for the retirement. This one is a CHUG, also located in Swiss, like Novartis, the pharmaceutical company. So the insurance company, they managing their money very well for long term. So one of the best insurance company is CHUG, and then recently the dollar index going down, and then the compared to dollar, the EU dollar going up. So it's the in the case, the I think CHUG is also good stock to invest, or either dividends and then the money exchange rate kind of things. And the price is around $129 now, but before it higher than 160, so it slowly catch up. But this is probably take about the 1 year or 1.5 year possible. But anyway, going up that way, and then in case the Fed increase their rate, then this company have a more beneficial like the other bank companies. So the buy and holding forever, yes. So what do you think about those nine stocks? My opinion is like if you miss the chance to buy stocks deep in last March, these are excellent to be added to your watch list. And then if there is a correction, we will say about the third quarter, we might have a big correction, talking about the 10 to 15% possible down. So in the case, in my case, I may buy some of them in deep, and once you buy them, then you may sleep peacefully. You don't need to watching your phone, see the stock markets, right? So it's buy and hold and forever stocks. And in my case, if I thinking about those stocks in my portfolio, probably about the what to say the 10, okay, 10 to 30% my case. But if you are young, you don't want to retire now, then maybe maybe close to the 10%, and then now there's gold and silver. You maybe think about the 20% of your portfolio. That'd be a good idea. And if you are close to the retire, then maybe you can think about the 50% to the 40%. That be the I think it's a good idea. And the other one is the instead of those individual stocks, you maybe think about S P Y V. The S P Y V means value stocks. Another one is the U S M V. That's the another ETF. So it's the less the functional rate, and then it's kind of steady growing of stocks in here. So well, that's all I think. Love once more. Thank you twice.